Viewers MCQ series for BFM, and today's topic is objective questions on market risk. Now market risk consists of various types of risk. Basic logic is whichever is not in your hands is a market risk. Okay, so follow this video till the end because very important topic. Okay, asked for many for almost 10 to 12 marks in exam. Firstly, download Adda 24/7 app on your mobile. In this app, you will be getting all the premium study materials plus live classes plus tests, ebooks, everything you'll get it over here. Okay, so download it right now. Subscribe to Officers Adda 24/7 YouTube channel. In this channel, you will be getting very importantly free YouTube series on various topics of JAIIB and CAIIB. Immediately subscribe to this, click on the bell icon. Also, you will be getting the updates for all the latest updates for JAIIB and CAIIB. Okay, these are the two new batches just now started. Okay, go for it immediately. English, bilingual, both are available. Okay, all the four subjects ABM, BFM, ABFM, BRBL, all the four are covered over here. So immediately go for it because 80% off is going on right now. Double validity on Mahapacks is available. What is it Mahapack? Mahapack means per subject you are getting more than 15 batches. Use the code Y432. Never forget this code. Okay, it will give you all these discounts. Okay, yesterday I asked you one question for homework. The liquidity risk of banks arises from, means from where does the bank get a liquidity risk? Liquidity means what? Liquidity risk means I don't have money to pay. Cash crunch, that is basically liquidity risk. Okay, cash crunch, right? So that is liquidity risk. So the liquidity risk to the bank arises from funding of long-term assets by short-term liabilities. Funding of short-term assets by long-term liabilities. Funding of long-term liabilities by short-term assets, and none of these. So from where does this liquidity risk come to the bank? Okay, what do you mean by this? But A, B, C. Let me explain you. See this one by one. Okay, long-term assets, short-term liabilities means I am having a FD. I'll prepare this case over here. FD, and second is what? Loan, right? FD and loan. So let's say FD is for 1 year and loan is for 3 years. What will happen? Suppose if I take a FD of 1 lakh for 1 year and I give a loan for 3 years, what will happen? After 1 year, this FD person will come to me, right? The account holder will come to me for withdrawal. So in that case, what happens? Where will I have the money? Because I have given a loan. This loan will be repaid in 3 years. So I won't have money. So that will lead to liquidity risk. So A can be the answer. What would be? Short-term assets by long-term liabilities. I am having a FD of 3 years and I am giving a loan of 1 year. So what will happen? This person who has given me the FD will come after 3 years, but this person who has taken the loan will repay in 1 year. So will I have any risk? No, because I am having that money whenever this person comes back, right? So here arises from short-term assets from long-term liabilities. This is out. This is in up till now. What about this third one? Funding of long-term liabilities from short-term assets. Short-term assets mean this is 1 year loan, and funding of long-term liabilities means how is this possible? Means I fund the liabilities from the assets. Always it's a reverse way. The bank always funds the assets from the liabilities. Bank never funds the liabilities from the assets. So this is abruptly out. Okay. So the correct option is A, funding long-term assets from short-term liabilities. Okay. Okay. Next one. Funding liquidity risk is defined as, means liquidity risk means what? Or funding risk, anything. We'll mark this over here. Funding risk or liquidity risk is defined as excess of liabilities over assets, excess of long-term liabilities over long-term assets, excess of short-term liabilities over short-term assets, inability to obtain funds to meet the cash flow obligations. So basically funding risk or liquidity risk relates to what? A, B, C or D. Be specific in the answer, because here many of you might feel that yes, A is also the answer. Why? Because liabilities over assets, more liabilities than assets. It will definitely create a funding risk. or liquidity risk. Similarly for others, B and C also. But in exam we get such answers which are very near to each other, and then we have to decide the exact answer. So what can be the exact answer over here? A, B, C or D? See here, A, B, C seem to be similar, seem to be right. Now what can be the answer? Type fast. Correct. Answer is D, inability to obtain funds to meet the cash flow obligations. And this is the exact definition of liquidity risk or funding risk. I don't have funds to meet my cash flow obligations. If I have to pay any, let's say, liability person, deposit person, I don't have money. Why? Because the loans are tied up. So that is basically liquidity risk. Similarly in your life also, in my life also, if I don't have money to pay the EMIs, what is that? That is basically liquidity risk only, isn't it? Not having money to pay the EMI, not having money to pay the daily bills, monthly bills, right? Electricity bill and everything. That is what? That is liquidity, isn't it? Liquidity risk in bank manifest means arises. Manifest means arises. Arises in different dimensions. Which are these? Means liquidity risk in bank. Basically, see here, why are we focusing on liquidity? Because this is the major part of market risk. Market risk mainly relates to liquidity risk over here. Okay, because this is only the problem. Market risk is the main problem of liquidity insufficiency. Okay, which are these? Funding risk arises from the need to replace net outflows, withdrawals from non-renewal of deposits. Means if my deposits don't get renewed, then I'll definitely face the funding risk, because depositors are withdrawing their money. From where will I give the loans? And why will the depositors withdraw the money? They'll withdraw if they see some huge problem coming in the market. Means some war like situation or something like that. Okay. Time risk arises from the need to compensate for non-receipt of funds. Means NPA. Means if there is an NPA in the loan, then definitely my deposit holders will come to me for money. And being an NPA, I won't receive the interest, right? So this will lead to what? This will again lead to this time risk. What is time risk? Time risk means similar to liquidity risk only. In liquidity risk, basically time risk and liquidity, how are they related? Here, on the exact time when I need to pay the depositors, I don't have money. So that's basically liquidity, isn't it? Call risk arises due to crystallization of contingent liabilities. Now crystallization means what? What do you mean by contingent and what do you mean by crystallization? See this. Contingent liabilities means what? Contingent means, let's say, bank guarantee, BG or LC, letter of credit. Okay. These are all contingent liabilities. And what is crystallization? Actual payment. Means it comes for payment and I don't have money. Means the basis on which I have given this bank guarantee, that person runs away, and then the third party comes to me for payment. So then I'll be facing the problem, isn't it? So liquidity risk can arise from what? This funding risk, non-renewal of deposits, or this NPAs, or this contingent LCBG, or so the answer can be A, B and C, all of them, or either of these. What can be the answer? Can the answer be D? Means all of them? Yeah, it is correct. D, all of these, correct? Because liquidity risk may come from all these three factors. Okay. When an asset is maturing in 2 years, the liability risk will be, means this asset is, what do you mean by asset? Asset means my loan. Loan is maturing in 2 years. I am thinking from the bank perspective. If my loan is maturing in 2 years, what can be the problem to me as a bank? Imagine if the deposits are maturing in 1 year, then what will be the problem? I'll face the liquidity risk over here, right? Or means that will be the basic problem over here. So the liability risk will be basis risk. Basis risk means what? Basis means this is related to market risk. Means what? The proportion in which the rate of interest of deposits and loans change in different proportions, different rates. Means my loan rate rises by 1% and my deposit rate rises by 2%. So that will create a basis risk. Yield curve risk. Yield curve risk is another form of market risk. Yield curve means the yield of the bonds goes up. Yield means here, logic is very simple. If the yield or the asking rate goes up, the price of the bond price, right, it goes what, down or up? Who can tell me? If the yield or the asking rate of the bond goes up, the price of that bond will go up or down? Type fast. Up or down, up or down, up or down? Yes? Down, right? They are inversely proportional always, yeah, right? So that is yield curve. Gap risk. Gap risk means what? The gap between the assets and the liabilities. The interest rate gap, okay? So the gap risk is related to that. Second, embedded option risk. So here will be the main problem. The liability risk will come over here, embedded option risk. Why? What is embedded option risk? Embedded option risk means, suppose if my deposit is maturing in 1 year, okay? Or let's say in 3 years also, 3 years. Suppose if there is a deposit which is maturing in 3 years. But what can happen? Tomorrow that person with the deposit can come to me tomorrow and tell me that, see, this is your slip, take this deposit slip and give me my money back. So embedded option risk means withdrawals, early withdrawals of all the deposits. Similarly, this loan risk, for this loan also there will be an embedded option risk. Why? It can happen that this loan is maturing in 2 years, but that it's a good loan, standard loan. So that person can come to me tomorrow and tell me that, okay, take this loan back, I don't want, I have extra money. So that is basically embedded option risk. So when an asset is maturing in 2 years, the liability risk will be embedded option risk, okay? The risk of adverse variance of mark to market value, of change in market prices, of interest rate instruments, equities is called as, what is this? Mark to market value. What is this? Firstly, mark to market value. See this. There are two books in banks always. One is banking book. Banking book, okay? Book. And second one is trading book, okay? Trading. So always remember, in banking book we always have the SLR and CRR requirements. SLR and CRR bonds, okay? These bonds we generally don't sell. But in trading book we are here for profits. That's called as proprietary, okay? So here I'll buy the bonds for selling. So if I'm buying the bonds for selling, I'll definitely see here, whenever I am buying something for selling, that is always subject to market risk. Market risk, okay? So that is always subject to market risk. So mark to market means what? If my price goes down, then what? So that is mark to market, okay? So change in market price of the interest rate instruments, equities is called as price risk, market risk, translation risk, and both A and B. Translation risk is totally different. It has nothing to do with this mark to market. Translation means what? It's just a notional risk, okay? Means, let's say I'll give you a simple example. SBI is having a branch in, let's say, USA. So on 31st March, that USA branch of SBI will show all their records and convert those records from dollar to rupees, and those records will be shown by SBI in its balance sheet to RBI. So that's called as notional and translation risk, okay? So that is out, remove that. Next is price or market, means change in mark to market or variance in mark to market is related to what? In market prices on the interest rate instruments, equities. So if it is mark to market, then both A and B can be the answer over here. Why? Because price risk is the correct answer. Price risk means what? My price goes down. So that is basically my price risk. But what is market risk? Market risk also means the same. Why does the price go down? The price goes down because of some market scenario, some Russia-Ukraine war, some COVID situation, right? Because of that it goes down. So answer can be both A and B, okay? Now let me come to this batch, okay? New batch which is started just now. I told you all the 4 subjects, double validity on Mahapacks, 80% discount is going on. Use the code Y432. All the numericals, objective questions, case studies Everything is covered in these batches. Okay, so go for it immediately. I'll show you at the end how to use this code. Okay, which is not a forex risk. Forex risk, why have we taken this forex risk over here? Because forex risk is a part of market risk. Always remember, it's a part of market risk. Okay, a risk which may arise due to favorable exchange rate movements is called forex risk. Favorable means if I bought a dollar at 80 rupees and tomorrow it's trading at, let's say, 90 rupees. So what will I do? I'll sell it. So is this a risk to me? So favorable exchange rate, will it be a risk to me? Yes or no? Just type yes or no. Favorable exchange. It is not. Okay, so this is not a risk to me because it's going in my favor. This occurs on account of open position in spot or forward contract. So this occurs on account of open position. What is open position? Open position means, remember, the day end position. Whenever I do a trading in treasury, I always have two limits. One is day limit and second is EOD limit. That EOD limit, whatever it is, that is called as open position. It is applicable to on an individual foreign currency. So which is not a forex risk. We want not. So this is not a forex risk. Okay, this can happen on account of open position in spot or forward. Okay, we want not. So this is true. Okay, what about this? It is applicable to an individual foreign currency. So is it applicable to an individual foreign currency? We want not. Okay, so arise due to favorable exchange. This is not a forex risk. Okay, this is also true because this can apply to dollar, this can apply to pounds, whatever it can be. So D is out. So the answer is, correct answer is what then? A, right? Because anything which is favorable to me is not a risk. Risk means what? Which is unfavorable to me, isn't it? The features of basis risk are, basis risk means what? Just now I told you that change in interest rate of deposits and loans changes in different ratios. So that is basically basis risk. So what is the feature of that? When the interest rates of different assets, liabilities and off-balance sheet items change in different magnitudes, it is called as basis risk. So all the assets, liabilities and off-balance sheet. Off-balance sheet means contingent liabilities. Off-balance sheet items are called as what? Everyone. Off-balance sheet means contingent. Give me the example of contingent. Type fast in the comment section. What is contingent liability? Just I gave you one example. What is that? One example. Simple. What is that? Yes, bank guarantee. Correct? Bank guarantee. LC. These are all contingent liabilities. Okay? Chalo. Yeah. So when the interest rates on different asset, liabilities or balance sheet change in different magnitudes, it is basis risk. Yes, that is a basis risk. Obviously. When they change, assets and liabilities change in different proportion, it becomes a room for basis risk. When the interest rate of assets rise in different magnitudes as compared to the interest rates in corresponding liability, which may result in net interest variation in net interest income, it is called a basis risk. So that is also true. Asset changes in different proportion to the liability. So this is also true. So the features A and B are true. C, the basis risk is quite visible in volatile interest rate scenario. This is very important. Volatile interest rate means usually fluctuating interest rate scenario. High interest rate changes. Okay. Example means October to December 22. Huge interest rate changes. Okay. So the correct answer is what? D. All of these. Okay. All of these are the features of basis risk. Always remember this. Basis risk means what? It's basically each and every, means it changes, whatever changes happen in the interest rates on assets and liabilities in different proportions. Now let me show you how to use this code Y432. Okay, for using this code, go to Adda 24/7 live. Okay, let's go to Adda 24/7 live. Let me see. Yeah, if you are having the app, I would suggest go on the app. Okay, in app you'll be getting 1% extra. Now you go to Adda 24/7 live. On the front page itself, click on JAIIB and CAIIB. Once you click on JAIIB and CAIIB, click on CAIIB 23. You'll see the batches over here. See the batches. Okay, CAIIB target batch. Okay, this one. Click on this batch, English batch. Okay, you'll see the details. What are the timings? What are the dates? What are the study plans? Then many other details. All the details you'll see it over here. Go through them. Ebooks are available, tests are available, recorded videos are available 24/7, interactive classes. So you can ask the question there and then itself. Ebooks are available. Now let me come to the fees part. 23,999. Okay, click on view offers. Put the code Y432. Click on apply. Look at this. 80% off. 23,999 reduces to 4,799. Huge discount. Okay, apply for this right now. I would suggest go for this Mahapack also. In Mahapack you are getting 15 plus batches. See this. Let me show you Mahapack. Okay, JAIIB CAIIB Mahapack. You are getting 15 plus batches. See this. CAIIB ka Mahapack. Okay, you'll see the details. Again go through the details. All the details are there. 15 plus batches for ABM, BFM, BRBL and ABFM. Okay, you can go through the details. Let me show you the fees part. In fees part, 35,996 now reduces to. Click on view offers. Put the code Y432. Never forget this code Y432. Click on apply. Now look at this. 35,996 reduces to by 80% to 7,199. Such a huge discount you are getting. Go for it immediately. Okay. Why am I stressing on these batches? Because look at this. The portion for CAIIB has changed. Importantly, the dates are out, everyone. Okay, the dates for your CAIIB are out. They are in June, exam dates, and registration is in April. Immediately join it. Okay, go for that and immediately join the batches. Look at the portion. ABM, BFM, ABFM new subject, BRBL new subject, electives HR, IT, rural, central and treasury. No elective of retail. Negative marking has been removed. That's a good sign for you. Okay, but you have subjective questions, so that's why I would suggest go for the classes, because you will be needing a mentor. Tomorrow I'll be back with another session. Till